Picture yourself flying low over New York City, the financial capital of the universe. You're in a helicopter next to the world's most famous investor, billionaire Warren Buffett, and Wall Street is burning. Vivid flames leap up from below as a twisted frown forms on Buffett's face. That's because the so-called Buffett Indicator, one of the best gauges of economic health on Wall Street and in the world of big investments, is flashing bright red. To make a long story short, this indicator compares the total market cap of all actively traded U.S. stocks to the estimate of last quarter's gross domestic product, or GDP. Buffett calls it probably the best single measure of where valuations stand at any given moment. The number stems from the Wilshire 5000 index, by the way, as reported in a 2001 Fortune magazine piece. This ratio tells us how fairly priced stocks are. It's a basic comparison to show if the market is over or undervalued related to economic output. If the stock market is growing way faster than the economy, that could be a sign of a dangerous bubble. Remember that frown you saw forming on Buffett's mug in the helicopter? It's all because of that scary bubble. Buffett's company, Berkshire Hathaway, informs us that 100% reading is fair. If it's closer to 70%, then stocks sit at a bargain price. On the other hand, if it's anywhere around the 200% mark, investors are playing with fire. It's time to get your fireproof cooking mitt ready. Wouldn't you know? Right now, the indicator hovers at a 2-year high. It's almost 190%. The last time the indicator was sky high like this was in 2022. At that time, it hit 211%, and the S&P 500 proceeded to drop a full 19% next year. All right, it's clear that you don't sit around on your hands watching the Buffett indicator go up and down. Suffice to say, markets have surged higher so far in 2024. Investors are jacked up about artificial intelligence stocks. Chip makers like Nvidia have rocketed to all-time highs. Is that anything for us to be excited or worried about? Let's find out. But in the meantime, Wall Street is betting there will be 3 interest rate cuts coming from the Federal Reserve in 2024. At the same time, 2 Fed officials predict no cuts at all this year, and that's pretty confusing, isn't it? It appears also that investors have been barking up the wrong tree. Not only does Buffett see Wall Street potentially burning down, other top analysts see all the hype over AI exaggerated and misguided. Legendary investor John Husman wrote in early 2024, "My impression is that investors are presently enjoying the double top of the most extreme speculative bubble in U.S. financial history. After all, Husman did foresee both the 2000 and 2008 market crashes." Meanwhile, yet another billionaire investor, Ray Dalio, rants that the U.S. government's decision in mid-2023 to dodge its debt obligation gets a grade D. Soon after the U.S. government decided to lift the debt ceiling, the national debt in the state soared $1 trillion in a mere month. These guys know how to throw our money around, don't they? The new amount of dastardly debt that sits heavily on the country's balance sheet totals a whopping $32.5 trillion. This is what we call a tsunami of debt that we're drowning in. Okay, but why is that a problem if our government one day pays off its creditors? Listen to Dalio as he talks about the stark scenario. Dealing with the problem of adding too much to a pile of debt that is already too large? Grade D. It won't make much difference, he added. In his direst warning yet, Dalio claimed that the U.S. was at the start of a devilish debt crisis. That means there's a worsening shortage of buyers at a time when the government most needs them to try to sell so much of this debt. In my opinion, we're at the beginning of a very classic late big cycle debt crisis when there's a supply-demand gap, when you are producing too much debt and have a shortage of buyers, Dalio boldly declared. On top of that, Dalio warned that the U.S. will soon enter a balance sheet recession. Higher interest rates will seriously hurt the economy. We all know that higher interest rates push prices up for goods and services. In turn, the cost of borrowing for that dream house or classic car reaches for the sky. On the flip side, since you can't or won't spend so much, you might end up saving some. Excuse us for asking a personal question. Are you or is someone you know dealing with credit card debt as we speak? You're surely not alone. Americans in general are wallowing in debt after hunkering down and building their savings during the pandemic. This sharp rise in credit card debt has been coming for a long time, with folks increasingly depending on fantastic plastic to buy stuff. But the rise is largely driven by factors like inflation and astronomical credit card interest rates, say the experts. Consumers racked up $180 billion in new credit card debt in 2022, the largest amount of debt ever accumulated in a single year, according to research from WalletHub, a personal finance website. One of the reasons that it's so easy to use credit is that we're psychologically removed from the impact for about a month. Only then, after 30 days, do we get smacked in the face with the new credit card bill. So now, you're in a heap of debt. How do you get out of it? If you're in a hole, stop digging. That's a basic piece of advice from Ted Rossman, credit specialist at creditcards.com. A couple options you have is to swap all of your debt to a 0% balance transfer card that charges no interest for up to 21 months. It's the interest that gets you, Rossman stresses. Or you can use cash or a debit card to pay for things. Then real money comes out of your account, which is much more tangible. Let's get back to Buffett for a moment, shall we? He's not heading for his fortified bunker in the Nebraska hills just yet. Wait, you ask, are there actually any hills in Nebraska in the middle of this massive country's corn and hog belt? Okay, you got it. Instead, let's say he's not heading for his bunker in the Black Hills of South Dakota just yet, which is not so far as the crow flies. It's useful to revisit Warren's advice only to keep everybody on their toes. He once famously wrote, "Be fearful when others are greedy, and be greedy when others are fearful." This simply means that when others are scared of investing money, like ahead of or during a recession, you could take advantage by scooping up stocks and other valuable assets at discount prices. In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a markdown price. Those are the exact words Buffett used in 2008 op-ed piece in the New York Times. Based on that, you still might not want to rush out and buy 1,000 shares of Nvidia to giddily ride the AI wave. In the face of a Wall Street crash or another recession when stock prices could plummet, what course of action does Warren recommend for the average investor? Most of us would be tickled to touch even the smallest portion of the billions Buffett and Berkshire Hathaway have in their bunkers, but that's unlikely. However, Buffett's first morsel of advice is to keep cash on hand so that people are going to keep making intelligent decisions rather than those forced upon them. The second tip Buffett shared with CNBC's Becky Quick: during stock market slumps, even the biggest blue chips can take a knock. So be careful about investing in a company that's recently seen a setback in its business and share price. Bear in mind, these downturns are usually hiccups, according to the Oracle of Omaha. Most major companies will be setting new profit records 5, 10, and 20 years from now, he wrote. Even though Wall Street may be on the verge of a fiery blaze, Buffett suggests we still take a business as usual approach. Don't stop investing altogether. By the same token, don't go off and buy a whole lot of exotic companies you wouldn't otherwise do. And Warren's fifth tip for this sinking ship economy: keep your eye on the long-term horizon. Remember that recessions are relative. Some last longer than others, but in the end, all are temporary. On the contrary, the stock market shows us a pattern of always trending up over the past decades. Such was the case following the Great Depression in the 1930s. Up it went during the economic malaise, along with soaring inflation of the 1970s and early 1980s, the Great Recession from 2007 to 2009, and then the recent COVID-19 pandemic we all remember too well. So, don't fret if you see your investments take a hit and sink before and during a recession. Rather, strive to maintain the Buffett mindset, knowing that the stock market must rise again. History has proven that it always does.